So I'm going to talk about how to pick an investment trust. I'm going to go through these slides pretty quickly because there are, to be honest with you, too many. But some of the more factual and educational ones at the front were in requests I got from customers who couldn't attend this evening, so they're there as much for their reference, but hopefully they will be useful for you as well. We've already talked about the importance of disclaimers and risk warnings, but if you could please just very quickly look at those, because I will be talking about investments, tax, and various other issues where we're not here to necessarily give advice. We're not here to give advice this evening. We're here to give information and education. But I'm going to talk about how the rules that you can apply when researching the investment trust, which is the second half of the presentation. I'm going to go very speedily through the first half. You're probably more familiar with the fact that you can, of course, through the AJ Bell platform, do this yourself, but equally you'll be aware of the fact that it takes time, it takes patience, it takes experience and expertise. And unless you're me, you really don't want to go home and read the Tesco report and accounts every single night. You'd rather watch the football or Coronation Street or whatever it happens to be. I get told off by my wife for reading the Bundesbank's annual report and accounts sat in bed. But generally speaking, there are better things for people to do with their time. You do need your downtime. And if you're not doing your research, you are potentially making life quite difficult for yourself going forwards. So that is why the fund industry exists, because there are experts in so many different fields who can help you, not just hopefully make your money grow, but protect your downside at the same time. And in many ways, that's the real key to it. We're all very, very good at looking for the upside. What we're not necessarily so experienced in is managing the downside and managing risk, and the two, of course, are inextricably linked. So when you look to a fund to save yourself the time, or some of the time at least, of doing the research, your cash is pooled with that of other like-minded savers, and you're therefore, even for a very small investment, you can get exposure to things that may be normally beyond your reach, may be difficult to trade, or you simply may not understand, but nevertheless could potentially benefit from. All, of course, in exchange for a fee in terms of the expertise that's on offer. And the great thing about funds is there is an enormous range of options. Just about anything that you would wish to invest in, you can, whether it's fairly mainstream asset classes like equities or fixed income or property or commodities, any geography you would care to think of, any industrial sector, any theme. There's nearly something for everybody out there. And then on the right-hand side of this slide, you have some of the more, eclectic's perhaps not the right word, but some of the less mainstream options available to you. We are talking about multi-asset this evening, for example, so that's definitely one thing that we'll be hearing about. But you can even get involved if you see the need in hedge funds, for example. Daniel Loeb of Third Point, for example, there's a feeder fund into his New York-based hedge fund that is a London-based investment trust. So there's lots and lots of different options for you, all appetites for risk, all potential target rewards, all geographies, all asset classes. Now, there are two main types of fund. We're going to hear about the one on the left this evening, the actively managed, where you have an expert or a team of experts making the picks for you. You've chosen their particular areas potentially being suitable for you. You've entrusted your cash to them. They then get on with it. We'll not worry too much about the hyperactive funds this evening. Or the other option, which we may perhaps talk about and we've talked about on previous investor evenings, is the passive side, where there is a computer program that will hold the underlying for you, and it won't try and beat the index, it will simply try and match it minus the fees. The active fund manager will not just try and match the index, the benchmark, they will try and beat it as well and justify their salaries and their fees in that respect to provide you with a premium, risk-adjusted, risk-managed return. So these are the educational slides I put in very quickly for some of the gentlemen and ladies who couldn't be here this evening, just highlighting the differences between a unit trust or an OIC or as they're now called, I think, by the FCA, an ICVC, an investment company with variable capital, just to keep the acronyms nice and simple. So these are ICVCs, and I think the key issues here, open-ended funds, investment trusts are closed-ended. Investment trusts have a finite amount of capital within them, and you actually buy a share in an investment trust, whereas here you simply get a share of the assets that are available within the fund. Different asset classes here, and again, all the different things that you need to know, reading the prospectuses, reading the key investor information documents so you know exactly what you're investing in. The difference with an investment trust is you don't buy a share of the assets as such, you buy a share in a quoted company on a stock exchange. So if you come to the AJ Bell Invest platform, all the dealing fees, all the commissions, all the spreads are exactly the same as they would be for any normal equity. So this is the slightly technical stuff. This is the sort of thing that Charles had me jumping hoops through to pass my investment advice diploma 2 years ago, so it's all very, very fresh in my mind, level 4. Again, I don't want to go through all of these, but I think the main ones to think about are, again, the status of the company, open of the collective open up closed investment trusts are closed set amount of capital. You buy a share. In terms of supervision, there's actually a company board. There are actually directors there working, one would hope, in your favour to make sure that the investment trust stays loyal to its mandate, does exactly what it says on the tin. There are rules laid down which with regard to things like gearing and how much borrowing the investment companies can use, which we'll come back to. Again, if you're looking to buy them, you'll be quoted a normal bid-offer spread as you would with a stock. And the valuation, that's simply driven by supply and demand in the market on any particular given day. So sometimes you will find in investment trusts, share price trades at a discount, or more or less frequently at a premium to the underlying value of the portfolio. And of course, the other advantages with investment trusts, if you want to deal quickly, you can, because there's a live price during normal market hours, whereas with an OIC or an ICVC, you could probably have to put in your order the day before. You don't know what price you're going to get, and it comes around about midday every single day. So there are some quite fundamental differences between the two, or the three, but I think this is probably the one that we'll focus on, because then it has implications for things such as the quoted price and such as the valuation. It's the closed nature of the fund that is perhaps the big difference, the permanent capital between the different breeds. And that's really what brings about the old market saying to a degree. There's an old market saying investment trusts are bought, not sold, because they are a quoted company, it's just a share. Now, it certainly isn't the case now in a post-retail distribution review world, but many years, certainly a good few years ago, there was certainly an argument that financial advisors didn't necessarily give investment trusts as much time as they would have done OICs or ICVCs, because they earned a commission when they sold the fund, and they got the trail commission as well from the fund manager. Now that's all long gone. RDR took care of that, but the theory being, so one, there was the issue of commissions, which was there for you to bear in mind, and the second one was that investment trust, this closed-ended structure, is potentially an inherent advantage. If you think about it, sectors, geographies, themes, stocks, in and out of fashion, which means that certain fund sectors can get very hot at a certain time, and they will attract naturally fund inflows as people get very excited about them. So the ICVC manager may have to deal with a lot of inflows when his or her sector's already done incredibly well, when potentially they're quite expensive. And because they're not paid to sit on the cash, you've given them the money to invest, they will do what they're paid to do, which is dutifully invest it to the best of their ability. The risk, of course, is then that if some of the hot money gets in at the top, things can go wrong, and the hot money can often bail out at the bottom. So then the poor old fund manager, whether he or she wants to or not, is forced to sell as people liquidate their positions and change their mind. With an investment trust, doesn't happen. The share price will move around according to people's greed and fear, their concerns, their enthusiasms, their passions, but they'll still have the underlying capital to invest, and that will not be affected by those fund flows. So it can release them from the pressure created by hot money in, cold money out. And that's why certainly you can get trends such as this, which is data from Canaccord Genuity, which is it's an investment bank, it's a broker, it's got no particular axe to grind. Admittedly, it's from their investment trust analytical team, but this is just data looking at comparable performance between investment trusts and ICVCs over a 10-year over a fairly lengthy period, I think 10-year period to December 2015, and in 10 out of 15 cases, the investment trusts have outperformed their OICI ICVC brethren. Now, I'm sure our learned colleagues here will be talking about their skill and how much of that was down to them, but equally some of it, I think, is probably down to the structural advantage that an investment trust can bring, in that the fund flows don't create havoc with the buying process and the philosophy and the methodology of the fund manager. So that, I think, is definitely one thing that you all need to bear in mind. Tax, it's always a bit of a tricky subject, but this is just something for you to bear in mind. If you do buy an investment trust, what you may be liable for. If you hold it through a dealing account, cleared through an ISA and a SIP, there'll be some differences there. Right, that's the technical stuff. So the key things to focus on there, the closed-ended structure, the valuation, what you're buying, and that permanent capital structure and the inherent long-term advantages that it can bring when used by a skilled fund manager and putting that your capital put in the right hands. So this is my personal 10-point checklist for how you would potentially go about choosing an investment trust. There are lots and lots of others, but for me, over the time, they've generally worked quite well, or they did work for me quite well, until Mr. Galbraith insisted that my money be run on a discretionary basis, which it now is, so no one can think that I'm taking the mickey standing up here punting things that I own. So that's something you don't have to worry about. So these are the 10 Mandate, style, fund provider, naturally the record of the fund and the individual manager, fees, process, resource, discount to NAV, dividend policy, gearing, and finally board composition. So mandate, now clearly when you come to invest your money, you're taking a risk, you're looking for reward, and you're trying to measure the two. But before you put any capital at risk, the 4 questions that you need to ask yourself are those ones. Why are you investing? Over what time period? What your target return is, i.e. how much money you've got now and how much money you want at the end, and therefore your appetite for risk. An appetite for risk in an investment context, according to Mr. Buffett, if it's good enough for him, it's good enough for me, is your tolerance for loss of capital on a permanent basis. So the answers to those 4 questions will go a long way to shaping which asset classes you're interested in, which geographies, which type of stock, and therefore what type of investment trust you're interested in, what mandate is best suited for you. Is it UK equity income? Is it multi-asset? Is it North American equities? Is it capital growth? All of those things will come out of asking yourself quite coldly and clearly those 4 questions. And then style, do you want income? Do you want capital growth? Do you want capital protection? Do you want a combination? Again, the investment trust, its documentation, its website will tell you exactly what it's trying to achieve and what the fund manager is capable of doing for you. The fund provider, we've got, as Charles has mentioned, 4 of the biggest names in the industry here with us tonight. Clearly, you will probably be drawn towards those whose names you're familiar with, who've got a strong brand, a strong reputation, known for strong finances, and also have good websites, freely available information, explaining to you very clearly what they do, how they do, and why they go about it. Now, we know, if the compliance department are watching this video, which I'm sure they will be, that the past is no guarantee for the future. Nevertheless, it is human nature to look at a fund or an investment company or a fund manager's historic record, because it is something that you can take a look at. This is a very difficult job, having tried to do it myself 25 years ago, and anybody who outperforms 6, 7 years in 10, believe me, is doing a fantastic job. But I do think you need to look at people over a very, very long period of time, not just 1, 2, or 3 years. You can look at their absolute performance and relative to benchmark through freely available websites. We get our data from Morningstar, I think, don't we, Charles? Well, there's lots of options out there. If you believe in such things, you can get star ratings from independent data providers. But nevertheless, it will be understandable that you would like to think that the fund manager, over a long period of time, can demonstrate their worth by providing you with performance and in absolute and also relative terms. And that, of course, helps deal with this question of the fees, where clearly you are paying for the access to these persons or this team's expertise, and therefore they're working for you to provide you with the best possible risk-adjusted return. Now, courtesy of the Association of Investment Companies, they're the average fees right now as of, I think, last Friday from their member community, which is the vast majority of the industry, just over 1%. Do note that there's been a gradual downward pressure on those in a post-RDR world. The ICVCs traditionally had a big premium cost. They've tried to drive those down, and that has led to some pressure on the investment trusts. 40, according to the AIC, have abolished performance fees. 90 have adjusted them, though having checked my notes on the way here, some of those have actually gone up. Not very many, I hasten to add, but 1 or 2 have actually nudged them up, mainly a result of the fact their performance has been fantastic. But the majority have taken those down. So fees is clearly one thing, but equally, you're paying for quality here. The idea being you're going to get performance, and one of the reasons you'll get performance is that these people can do so much that you can't on your own. You'll be interesting for you to know how many people work on the investment company, how much research do they have available from in-house sources, how much expertise do they have that maybe somebody else doesn't have. And again, you'll also be looking at their style, their philosophy. I know, having been both a fund manager and then a broker at SG Warburg and then UBS Investment Banks, I used to talk to these people all the time. Some fund managers swear by company meetings. Some fund managers never want to see a management team on the ground at all. Think they're going to get is a lot of old nonsense that's far too bullish and just not worth listening to. So again, you will get a feel from maybe listening to these people tonight, how they work, what they think is important, and then you may think, actually, yeah, that's the way I'd like my money to be run. Thank you very much indeed. This issue of discount to NAV, again, because of the permanent capital structure, it's a bit of a wrinkle in investment trusts, and it can be an opportunity. If you think you've got a particularly well-run fund that's got a particularly good long record, it may just be in a bit of an unfashionable, unpopular area for a while, or it may have genuinely had a bit of a performance wobble. let's face it, we can't get it right all the time, and generally the best players are early. So there may be a period when things don't look so good. You then can get a situation where the discount to NAV opens up. And that, if you then find that you've bought in at the right time, can work in your favour, because the underlying assets will rise in price, and the discount will close up, giving you a double whammy in terms of your share price performance. Can, of course, work the other way. If a sector has a bad patch and the underlying goes down and the sector falls out of favour. But nevertheless, the average discount is around 6%. This, interestingly, is the historic discount for AIC members all the way back to 1997. And as you can see, in a sort of post-RDR world, the gap has begun to close up to actually record lows last year of around 3%, before opening up again to sort of 4 or 5%, 6% right now. There were some funds, very notably last year, that traded at very, very big premiums. There was one particularly big fund run by a chap whose name begins with W that went to quite a large premium at one stage, which is now closed up. And even now, some of the very strongly yielding or income-driven funds, like infrastructure funds, are still trading at a premium. Now, I'm not saying don't do it, because I'm not here to give investment advice, but clearly if you do pay a premium, you are going to be giving away some of your future returns. So it's something you do need to think about very, very carefully. But catching a well-run fund at a bit of a discount can help provide you with a little bit of extra on the return front. And clearly, in some cases, a key part of your return isn't just capital return, it's income. Now, we all know with Mr. Carney potentially going to go through his whole career as chairman of the bank, governor of the Bank of England, might never once raise interest rates the way things are going. So let's face it, income's going to be, isn't easy for everybody to find right now. Cash in the bank at 0.5%, 10-year government bond at 1.4%. It's pretty tricky out there. Some investment trusts, and I'm not going to embarrass some of our speakers later on, I've got a fabulous record of not just dividend payment, but dividend growth. 19 investment companies have increased their dividend every year for at least the last 20. I think there's a couple up in the high 40s, and maybe one even at 50. Another 18 for 10. That is incredibly powerful. And maybe one or two of our speakers will talk about how they can manage that process, because they are allowed to pay dividends out of reserves and smooth their dividend and create a nice run over time. So they will literally take you through the rough with the smooth if they manage their funds well. And also note for people who are perhaps in income drawdown, who are looking to live off the income from their portfolio, 43% of AIC members now pay quarterly dividends. 5 actually pay a monthly dividend, intriguingly, though again, clearly, you would need to make sure that those funds, you don't just buy them for the fact that they pay quarterly or monthly, but they fit all of your investment criteria. But nevertheless, that is quite a powerful trend for anybody who is looking for income and is looking for that to help them with their day-to-day financial requirements. Gearing. They can borrow, they can gear up to magnify income. The current average is only 7%. So you're not seeing people going around betting the farm here. You're not talking about some of the leverage that you see with hedge funds, which are very, very aggressive. But nevertheless, it is something that can help to magnify returns. Equally, of course, if it goes wrong, it can help to magnify losses. And then the final of my 10 points to watch for is board composition. It's just like any company. Now, clearly, corporate governance, after what's gone on BP, Shire, Reckitt Benckiser, and other companies, in terms of pay has been a big issue. But governance is very, very important for your investment company as well. The board is there to monitor performance and ensure that shareholders, stakeholders' interests are protected. So certainly make sure that the board is there to, got the right skills so they can do the job properly. In rare examples, I think the board can even change the fund manager, and I think BlackRock was a beneficiary of that a couple of years ago. It doesn't happen very often, but if a board is sufficiently underwhelmed by performance, they can actually do something about it, and in the view that may be potentially in your interests. So that's a very, very quick checklist of 10 points. I appreciate it was a bit of a whirlwind tour. I'm sure that all of our guest speakers will touch on some of those intentionally or otherwise in their presentations. And then in the Q&A at the end, if you feel some of those issues haven't been addressed, then I'm sure you get your chance to ask our speakers. So this is a conclusion. They can serve a fantastically valuable purpose. I've heard that Mr. Galbraith's portfolio is absolutely bursting with them, so they're clearly no bad thing sometimes. Risk management is clearly just as important, though, as search of positive returns and outperformance. And the trade-off is, yes, there is a fee, but they're saving you time, they're bringing you expertise, and they're helping you manage risk. And I suspect that over time there will be further fee pressure. And this closed-ended structure does potentially have structural advantages relative to classic funds, OEICs and ICVCs. Again, there's none of that commission business, so that is less of an issue now. But again, the long-term nature of the capital in the fund means for patient investors. They're a great vehicle. The MiFID thing, this is going to be more of an administrative thing. The European Union, and I'm not getting into the Brexit debate, by the way, doesn't necessarily recognise investment trusts because they're not UCITS funds. So there's a possibility you may need to fill in a form from 2018 onwards to say that they are suitable investments for you because they're deemed to be complex, which, let's face it, if you think an investment trust is complex, has anybody read HSBC's report and accounts this year? All 650 pages of it? I mean, come on. Let's face it. It's a rule that's probably coming. I know it's been resisted, but I suspect it'll come, so it may be a slight administrative inconvenience for you, but we'll do our best to help you. But ultimately, all of these issues, gearing, discounts to NAV, dividends, buyback policy, the skill of the fund manager, they do all need to be researched. So even once you've selected what you think is right for you, just like any stock, any fixed, any bond, any security, you do need to do your own research before committing capital. And our 4 speakers tonight will help at least short-circuit some of that for you by talking through their area of expertise this evening. So thank you very much for your time, and I look forward to seeing you for the Q&A later on. Thank you, everybody.